I'm going to show you guys how to use inversion fair value gaps for high quality setups. I'm going to be showing you guys an example of a trade that I'm currently in right now. I'm looking for price to draw up into these relative equal highs. I'm just targeting the easiest target at 49.50. So we'll watch this play out live together. I'm looking for price to draw up into this level. If I move the recording, you can see in the bottom right, it shows the time. You can see that time aligns with the countdown to close on the candle bar if you look to the right. So this is live price action. So what started this analysis, you may ask? So why am I in a position right now, 5 contracts? This example is just on a paper trading account, just for example purposes. Well, I need some type of higher time frame bias. So what I'm not doing is waiting for price to just break above a bearish fair value gap and then long in here. What I am doing is figuring out a key area where I anticipate a reversal at and then look for an inversion fair value gap to form. Once price closes above it, so if you're new to ICT concepts, a bearish fair value gap is just between this candle's high. So it's a 3 candlestick pattern of fair value gap. You have candle number 1, which I'm pointing to, candle number 2, and candle number 3. I'm looking for candle number 1's wick and candle number 3's wick to not overlap. See how on my cursor, this wick and this wick are not overlapping. That's a bearish fair value gap. A bullish fair value gap would just be exactly that on a green candle. So just for example purposes, I'll show you what that looks like. We have this right here. So between this candle's high and this candle's low, that'd be a bullish fair value gap. Obviously you could see it failed. So I'm going to show you guys when to anticipate PD raise to work and also when to anticipate inversion fair value gaps to work. On the 15-minute time frame, I'm using the 15-minute as my higher time frame. Now some of you guys are like, whoa, what do you mean he's using it as his higher time frame? You do not need daily or weekly bias to have higher time frame bias. I'm simply utilizing a 15-minute chart as my higher time frame. What you do need is you 100%, this is a must, this isn't a maybe if you want to, you need a higher time frame bias. You need to have a potential draw on liquidity, and you're using this model as feedback from the algorithm of where price is likely to go. So you need to know where and when to look for these setups. We have this previous low over here. If you look at this entire move down, okay, price reversed up here. It returned all the way back down. We're in a deep discount and price took out sell side liquidity. So we're in a discount from this range low to this range high, and price took out a 5-minute sell side liquidity pool. So I'm going to go back to it in a second because we're just about to hit the take profit on there. We have this old low. Why is this significant? Because it's in a discount. It's also retesting this breaker right here. So if you look at this breaker, right, price took out sell side liquidity and it's tapping into that breaker. If you want to level up your ICT trading, I have a premium Discord where I call the market real time and show exactly where price is going every single day. So I went 3 for 4 today. Here was the inversion fair value gap setup that I did share with Discord members beforehand. I said, seeing if price can run up to 49.50, we have sell side liquidity purged plus a bearish fair value gap inversed. So Discord members knew that price would run up to this level beforehand. Also, I do have a 7-video course in the Discord, which shows how to trade ICT concepts from beginner to advanced. If you're interested in any of that, it's $30 a month, which is $1 a day. You can find a 3-day free trial link down below. So price took out the sell stops. Now, if we look on the 1-minute time frame, what I'm looking for price to be delivering from liquidity and then deliver higher, taking out a fair value gap. Okay. Now, what does that mean? Well, I'm going to look for the most recent liquidity ran. What is that most recent liquidity ran? Well, these sell stops in the 5-minute that we just talked about. So we have these sell stops. Okay. When price takes that out, I'm looking to see 3 things. Does price consolidate? Does it reverse? Or does it expand? What does the price do? It reverses back higher. So what am I looking for? I'm then looking for price to break above a fair value gap and inverse it. So what I'm looking for is I'm looking for this fair value gap that we just talked about. I'm looking for a singular candle close over it. That's all you need. 1 candle close over that bearish fair value gap. Once you have that, that's all that's needed for price to start repricing higher to liquidity. So you're going to aim for liquidity now. So notice price took out the sell stops right here. Price, what did price then do? It displaced higher and it broke above this bearish fair value gap. And what did it do? It closed above it. Notice where my entry is. My entry is when price starts to pull back down into the fair value gap. And then what am I anticipating for price to do in this fair value gap? I'm anticipating for price to bounce off of that and start springing where? Higher towards liquidity. Now I will take off 2 partials here just for sake of You don't need to hold just for one pool of liquidity. In fact, especially if you're new, it's better to take off at different levels. In this example, I'm partialing at this breaker. So we have this bearish breaker right here. That's where I'm taking 2 partials at, still holding the remainder 3 contracts for that first initial high. So we're anticipating for price to move from sell stops, where? To buy stops. Okay. Where can your stop loss be in this, Dan? Well, you notice where mine was. It was a low beneath the fair value gap. So look where my stop is. Pay attention to this real quick. My stop is at the low beneath the fair value gap. If I'm anticipating for price to reprice higher, I don't want to see price break beneath the fair value gap, and especially not a low beneath there. What's the safest stop for something like this? Safest stop would be at this previous low. We're going to mark out this red level. You can see that did hit the take profit. You see in my voice that I'm not surprised because I see this occur every single day. And once you see it occur every single day, you'll start to notice the same thing. Well, Dan, what about this inversion fair value gap over here? Why didn't that work? Well, you would have got stopped out on that. Did this one take out liquidity? No. It needs to take out liquidity. It needs to be delivering from the liquidity, displace higher, and then break above the bearish fair value gap. That's when your higher quality setups are going to occur. Now, does that mean that there can't be any inversion fair value gap setups that didn't take out liquidity? That's not what I'm saying. I'm saying that you're better off. You're going to see higher probability setups when price takes out liquidity and displaces higher. Price returns back down. I'm entering inside the fair value gap. You can see that my entry was, I didn't have the best entries on here. Like, look where I got that one contract filled. Got these filled in that lower wick right there. I mean, I was still pretty much bottom catching these candles right here. But you don't need to catch the absolute bottom to catch this move. You could enter in close proximity as long as the RR is good enough for you to have your stop beneath a low, beneath the inversion fair value gap. Or the safest stop, remember, the safest stop is going to be this low. This is the protected low until price reaches the liquidity higher. So it took out that first high. It can reach into these as well. I'm just taking off of the easiest high right here. You may say, well, that's not liquidity, but if you were to look on a 15-second, that high would look more significant. So that's going to be it for this video. Just a very quick video today. What I showed you is that in an inversion fair value gap setup, you're looking for liquidity to be ran. You're looking for displacement away from that liquidity. And you're looking for price to break above a bearish fair value gap and close above it. Once it closes above it, it can run for the nearest liquidity. That's going to be it for this one. Hopefully you guys enjoyed this. If you did, make sure to like, share, and comment down below. And I'll see you guys in the next video.